Hey traders, it's Jeff Tompkins, Chief Investment Strategist at Altos Trading. With geopolitical uncertainty, soaring oil, inflation fears, and headline risk at the forefront, let's break down what's driving markets this week.
So let's hop over to the charts of the SPX. We are trading below the 200-day moving average. So we've now had four consecutive closes below the 200-day moving average, which signals a not so healthy market, right? Generally consider the market to be in good standing and in broader health when it's trading above an upward sloping 200-day moving average. And we just got another close below. So that's something to keep an eye on. I think if we recover back above the 200-day and post some consecutive closes above there, that could be a good indicator that we're more likely to have a sustainable upside move. But as long as we're below the 200-day, we should probably focus more on short opportunities. But essentially what we've seen in the last couple sessions is volatility with not much, excluding any gaps up or down on the open, not much movement off the open, right? So we're closing near the open with significant intraday volatility. Uh, and so this is what can create challenges for directional positioning. So right now I'm trying to stay out of directional trades, not trying to go long or net short. And if I am taking some degree of a directional bias, using defined risk spreads predominantly. Okay, but in terms of levels, all right, so SPX closed today just above the 65.50 half century mark. And that's going to be kind of our first area of support. Let's see. But I'm going to make this a support zone. I don't know if I drew that up quite high enough. It should be pretty close. Because the critical level I want everybody to watch is 6,500. We could more specifically use the March 20th low. So that's the low of the year. And it's actually the low even if you include Q4 of last year, right? So we haven't had lows below or trade below 6,500 except on this one day. And so if you look at the options chain, right, you're going to see a lot of open interest stacked up at the strike. And let me get this marked here, support. All right. Since we've already dipped below 6,500, I feel confident that if we dip back below it, we're very likely to see an accelerated sell-off without having the daily close confirmation. But certainly a daily close below there would not be good. I just think it's less likely we're going to have an intraday dip below there again, like we did back on the 20th, and then recover back above. Uh, I'll also point out, because this is going to be our resistance level, that 5% drawdown level from all-time highs. Okay, so this will be resistance 1. And again, because it closely coincides, I would incorporate the 200-day moving average into that as dynamic resistance. But this is going to be up closer to the 66.50 level. Okay, I'll just put that on here. All right. And then we have our downward sloping 20-day average coming down into the, and it very likely will rotate down into the 6,700 century mark. So I'd watch that as dynamic resistance if we were to recover back above the 200-day moving average. Let's see. And then really the next level I would watch from there, obviously always watch your century marks on the SPX. So 6,400, 6,300, 6,200. But the next big one would be 6,300 because that is the 10%, would be a 10% peak to trough drawdown. So those are really the big ones I would keep an eye on. Well, let's just take a look at the expected move going out to the end of the week to Friday, which is March 27th. So we have two trading days behind us, right? So just three left in the week, and we still have just over 132 points of expected move in the SPX. So that could easily get, and we're exceeding daily expected moves. Uh, we've already tested the upper weekly expected move, upper range. But that could easily get us down to, around 6,400 by Friday if we continue to rotate lower. The other thing I'll point out real quick is we're likely to get a bearish pivot high here on yesterday's session high. So we have two lower highs to the left of this potential pivot candle. We've put in a lower high to the right, one more lower high to the right, and we'd have a bearish pivot because we actually are in bullish pivot conditions since the March 20th candle has two higher lows to the left and two higher lows to the right. A confirmed entry here would be a trigger above yesterday's session high. So we'll see if that happens. If it does, then the weight goes to this bullish pivot. But if we put it in another lower high relative to yesterday's high, then I'd be watching session lows because we could very well take those out. But just in terms of fundamentals, so this is going to be probably a pivotal week because Trump came out yesterday on Truth Social and said that they're holding off on any attacks on the energy infrastructure in Iran, and they're giving them 5 days to reach a peace agreement. And then we got some news from the New York Times this afternoon reporting that the U.S. has sent Iran a peace plan to end the war. So let's actually just take a look at the S&P futures here. So they're up a little bit after the cash close today. We did get a pretty swift bid under the market towards the latter part of the afternoon. We'll see if that all plays out. So this, again, I think will be a pivotal week in terms of whether we get a peace agreement here with the whole Iran conflict. As long as oil remains elevated, it's very unlikely the markets are going to have much upside potential. So oil's a great barometer right now, even though the volatility in oil and energy is creating challenges for directional trading in the markets. The gift it's giving us is that it is a good barometer for whether or not there's going to be more selling or we're going to recover on a more sustainable basis and see a rebound in the market. But USO today closed up above the 114 handle, gapped higher. We are getting some range contraction here. But I would just really watch some of these more significant lows. Watch the 100 level, like to see that come back down below 100 and stay down below 100 on a daily closing basis. And I think until we start seeing daily closes below 100 on USO, then more likely to see elevated volatility and more selling. So again, I think that's a good barometer. Uh, we'll hop over to the Qs, which are also trading below their 200-day moving average, four consecutive closes below. Slingshot set up here with breaches of the lower Bollinger Band and simultaneous divergence of the outer bands. But we're also down around support like on the S&Ps. And here's what's really critical is if we look at the 10-year, all right, since the end of February, it's just gone parabolic. So we've seen, so this is the rate that impacts your mortgage, your car loans. Okay. It's not the Fed funds rate. That's the short-term rate, right? That affects overnight borrowing in between banks. This is actually what impacts the consumer. And this is just shot way up. And this is actually what's weighing on things like the metals, right? So we've seen a sell-off in gold and silver this month. Okay. This uh normally you would think, right, when there's political turmoil, there's a war going on, right, there would be capital rotation into safe havens like gold and silver, but they're selling off. And um that's because there's this there are inflation fears, and I'll kind of walk you through this because I think it's confusing um some people. And I covered this in our trade room earlier today. So this all really ties into oil. So, of course, the Iran conflict is going to push oil prices higher, which it has. And then rising oil then fuels inflation, right? And then rising inflation hurts the expectation of future rate cuts. So when yields rise, gold becomes less attractive. So that's the whole kind of cycle that's playing out here that's causing gold and silver to sell off. So gold isn't falling because of geopolitical risk. It's falling because of that whole kind of loop that I just walked you through, right? It's oil impacting inflation, impacting Fed fund rate cuts, impacting yields, which then impact gold and silver. So that's what's happening here. So we could see a near-term rebound. We got a little bit of a bid under gold around the 400 century mark today. Could see a bit of a rebound as perhaps the 10-year pulls back a little bit. It just hasn't started to do so yet. So if we start to see the 10-year pull back, you'll see gold and silver go up. All right. So volatility. All right. So if we look at the vol futures, our current active contracts oops, are the April contracts. And those are in backwardation still. So they are currently priced 24.05 and above a little over 50 cents above the May contracts, which expired 56 days. So we're in backwardation, but it's a relatively narrow backwardation. So you always want to pay attention to the spread, whether we're in contango or backwardation. Uh, if we were like more in a 2 or 3 point wide backwardation, then uh, there's indicative of much more fear and uncertainty in the market. So, all considering, this is not a big backwardation, but it does persist into June. So the Mays are priced higher than the Junes, just slightly. And then we go back into contango between the June and Julys, but then more backwardation relative, although it's extremely narrow, to August. So kind of an interesting volatility market right now. We'll look at the VIX. And I think to me, what's most concerning is that, okay, there's obviously a lot of uncertainty around the Iran conflict. It could end very rapidly or it could drag on, and nobody knows. Uh, but I think the safer assumption is that it is not going to just easily resolve itself, right? Like just one day it's all over. But that's again largely going to be headline driven. So it doesn't have to resolve itself. All it takes is a tweet or a true social post saying, you know, everything's okay, or don't worry, everything's going to be fine, and then the market rallies. But I think what's kind of most concerning with the vol markets, if we look just back from the start of the year, volatility is just steadily increased, and each pullback we get results in subsequent higher lows. So we still have an elevated VIX. Today's closing print just under 27. It kind of looks like back in 2022 in the bear market, where it just kind of was bouncing around between 20 and 35 and just never really getting back below 20 and staying down. So that's, I think, what's going to be key to watch. We'll certainly get vol contractions and pullbacks, but if it does not stay down, so if we don't get a VIX that persists below 20, that'll be concerning. Okay. And that's just kind of been the case this year. Vol contractions are quickly met by vol expansions. And the other telling thing is that the VVIX that measures the volatility of the VIX has done the same thing. It's today's closing print just above 124. So it's not common for the VVIX to stay this elevated for this long. So this is, I think, a good indication that there is significant market weakness below the surface that isn't yet being priced into the market. So in the midst of all this, a high VVIX, a VIX that's refusing to contract significantly, we're not seeing all that much sell side activity in the market. We haven't even had a 10% correction. I mean, it's much more common to see when you see VVIX and VIX prints of these levels to see a 10% peak to trough drawdown in the S&Ps.